bring our next speaker to you. We've had the pleasure of interviewing her on Bad Crypto probably a year or so ago. And of course, the world has changed dramatically here. Caitlin Long is her name. She's a 22-year Wall Street veteran. She's been active in Bitcoin and blockchain since, get this, 2012. That is some OG stuff. She lives in Wyoming, and she's been one of the ones to help lead the charge to make the state an oasis for blockchain companies to really spur innovation. She's here to join us now. She's going to be talking about how the macro environment helps crypto adoption. So everybody out there, just stand up and cheer and give a warm virtual Blockchain Week welcome to Ms. Caitlin Long. Hi, Caitlin.
Hey guys, can you hear me?
Yeah, good to see you again.
Howdy, good to see you again too. This is a great event you're putting on. Thank you for having me.
Well, thank you for participating. I love the Mustangs there behind you.
Yeah.
Are they Mustangs?
Little Wyoming theme. They are. It's done by a local artist, and some of you might have recognized. I used to have this in my background back when I lived in the New York area, and now the Mustangs came back to Wyoming with me. So.
Well, I drive a Mustang, so I immediately recognize them from my steering column.
There you go.
We're going to let you take it away. I know you've got a presentation you want to share, and then we're going to come back and probably have a couple questions for you. So go for it.
Sounds good. But the title of my talk is How the Macro Environment Helps Crypto Adoption, and I'll go for about 20 minutes, then do some Q&A. First of all, this is not investment advice, and it's also not speaking on behalf of my new company, Avanti. I'll give you 5 points about the macro environment that will help, I think, put into perspective what we're facing and the historical implication of crypto. First of all, the virus was the pin that pricked the credit bubble. The virus isn't the problem itself. It's obviously a tremendous human tragedy. It's affected my family, so though luckily my relatives have recovered. But the bigger issue is that it was the pin that finally pricked the credit bubble. That credit bubble has been building in the Western world for more than 5 decades. And multiple times, the free market attempted to reassert itself, and prick that bubble. And when the debt inflations happened, the central banks of the world were always able to reinflate. And the reason they were always able to reinflate, and this is what the Austrian economists got wrong when they were predicting hyperinflation as early as the 70s when the dollar went off the gold standard, and then again in multiple events, including 2008 when the Fed expanded its balance sheet, we didn't see the dollar collapse. And the reason is because there was plenty of balance sheets still left over to absorb the new debt issuance that was used to reinflate the system at the time. It's not clear whether we are at the end of that rope yet, or whether we will, the Fed will be able to reinflate. I suspect it's going to take a lot to reinflate. And just to put into perspective, the fiscal and monetary stimulus now is about $7 trillion. Just in the last 2 years alone, in the United States, non-financial sector debt ballooned by $7.5 trillion. So essentially, what's happened is we've backfilled essentially for the debt that was issued in the last 2 years at the peak of the credit bubble, where pretty much, I would venture to guess, virtually none of that $7.5 trillion of debt that was borrowed in the last 2 years in the United States actually produced anything of real value. A lot of it, as we know, went to finance stock buybacks and the like at inflated prices. And so leading now to number 2, if the virus was the pin that pricked the credit bubble, what does that mean about the credit contraction that we're seeing? And the hole that has to be backfilled by that debt that's gone away because it's literally defaulted or implicitly defaulting as the private sector is contracting the total amount of credit that it's providing, and governments, including central banks, are backfilling for that hole. What it means is that there was a massive amount of bad investment that was latent and just hadn't become evident yet to those who were watching in the economy. And the thing that to me is the most persuasive about the Austrian view of the world is the notion that entire industries make the same economic calculation error at the same time in the same direction. And we're seeing that in especially the oil and shale industries this time around. We saw it in the housing industry in 2008. How is it that a lot of really smart people end up making the same economic calculation error in the same direction at the same time? And the answer is because they're taking bad signals from the market. They're not stupid. They look at their math, and it looks like the projects that they're looking to invest in actually will generate a positive economic return. In other words, a return greater than their cost of capital. What they missed is that their cost of capital is actually a lot higher than what the market said it is. In the impact, in the face of all that, until we really know what the free market and interest rates are going to set the price of borrowing money, one of the interesting incentives that we have is to focus on shorter term projects, shorter term investment projects with shorter term payback periods, and also to focus on what a lot of us in this industry are doing, which is to build alternative financial infrastructure that's not burdened by the history of the latent default and latent capital misallocation, the sins of the past, so to speak. So that brings me to my third macro point, which is that these kind of environments are really just restructurings. We shouldn't be afraid of the word bankruptcy. It's actually a really integral part of capitalism, but it doesn't necessarily mean the companies go away. It's actually a period of time when the factors of production in the economy move from weak hands, who know how to, or who've destroyed economic value with those factors of production, to strong hands, people who actually know how to generate real economic wealth in the face of in the hands of those factors of production. And we need those sorts of restructurings. My fourth point is that there's a lot of populism criticizing those who misallocated capital, but I'm going to defend them, and maybe in a little unpopular position here, and say that the system was designed in such a way that the incentive was to lever up balance sheets and not pay attention to solvency anymore. And I think you're seeing that, right? A lot of the publicly traded companies that are now running for bailouts to Congress and the Fed were those who bought their stock back at higher prices. They absolutely had an incentive to do that. It absolutely, in the old system, well, again, we don't know if we're moving to a new paradigm yet, but certainly in the old system, the incentive was to lever up and buy back stock and strip capital and literally hollow out the solvency of the system. That is a function of the fact that the US dollar is the world's reserve currency. And if you've been following me on Twitter, you've noted that I've actually been doing some history reading. There was a French finance minister who called the dollar, being the world's reserve currency, the exorbitant privilege. And what we're seeing is exactly as he predicted in the 1960s, that what would happen is that the dollar would be over demanded as use as a currency in trade. And so there would be a natural short position that builds up in the dollar because there's a shortage of natural dollars out there, right? The dollar is used by a lot more than just the US economy, it's used globally. And as a result of responding to that shortage, that there would be an overissue of it, and eventually its value would not be sustained. We're not there yet. But I think we're witnessing the pressures there, that the dollar shortage that we're experiencing right now is acute. It seems counterintuitive because the Burr meme indicates that obviously there's been a lot of dollars created to try to backfill that hole. But by the same token, the size of the short position in the US dollar is just staggering in size. So far we haven't actually seen any of the negative implications, at least directly to the dollar's value. In fact, the opposite is true. And I do believe that the dollar is going to encounter a short squeeze of staggering proportions, even more so than we're experiencing now. And then the overreaction to that is ultimately where the real problem lies. And that leads me to my last of my 5 points, which is that I think at this point, given that balance sheets hadn't mattered, they will start mattering again at some point in the near future. It's probably, if it's not now, it's during the next crisis that follows, where the balance sheet gets totally used up. And therefore, here's the punchline: we want to understand what assets we own that are nobody else's IOU. One of the interesting things about the crypto industry, as you know, is that they are naturally equity-based assets. They are no one's IOU if you own your own private keys. It's the same thing as you owning the deed to real estate. It's the same thing as you owning the actual physical gold bar. Those are assets that are no one else's IOUs. But you do have to be careful, because a big percentage of the total market value of the crypto industry is IOUs or is backed by IOUs. Namely, if you look at the volume of crypto assets that trade, well over a third of them every day are stablecoins that are backed by IOUs. The stablecoins themselves are not IOUs. They are equity-based assets, but the assets backing them are IOUs. And also the Bitcoin and Ether, Nick Carter did an estimate that about 25% of the outstanding Bitcoin and Ether is custodied. And so effectively those are IOUs as well. So if you take nothing away from this talk, it is look at your own balance sheet and understand what assets you own that are somebody's IOU and what assets you own that you own outright. Because I think it hasn't mattered, to my previous point, the incentive was to lever up balance sheets, but I do believe balance sheets are going to start mattering again. And in that environment, that's when assets such as crypto assets that are nobody else's IOU become very valuable. Let me close by saying, as a result of these 5 points I just laid out, I'm going to give the crypto industry a challenge, which is that we have no clue whether the exchanges and custodians in this industry are actually solvent. There is so little disclosure of the balance sheet composition. Almost nobody's audited. And even if they were, audit standards probably wouldn't catch a lot of the rehypothecation of assets. That's why, for example, in the mainstream financial services industry, some financial institutions, well, they all look like they're solvent, right? But if you were to strip out all the double counting of assets that the accounting system allows, you'd realize the system itself isn't solvent. We don't want that to happen to the crypto industry. And so the one thing that from a challenge perspective, that I would issue to everyone in the industry is let's clean that up. We don't want to basically just recreate another version of the same thing where the balance sheets don't matter. I, for one, would be happy to see some of the weak balance sheet players flushed out of this industry and let the strong balance sheet players who are providing valuable services and helping crypto adoption rise to the cream of the crop. Let me stop there and see if you guys have some questions.
That was great stuff there. Thank you so much, Caitlin.
Thank you. Hey,
Yeah.
You're back. Awesome.
Yeah. Now one thing that you mentioned, and it is if you take a look at a dollar,
Yeah.
and it says that this note is legal tender for all debts, public and private. This is not an asset. This is a debt.
Well,
right?
It's an asset that's someone's IOU. Yeah, that's right. That's right. It used to be backed by something real.
Yeah.
The dollar, well, originally it was silver coins.
Mhm.
That's what it is actually defined as in Article 1, Section 10 of the U.S. Constitution. But for the last century, really, dollars have been effectively warehouse receipts. And as you know, the assets backing the dollar increasingly have been dwindled away. And so implicitly, if I tie back to one of the points I made in the presentation, the reason why why the central banks have been able to reinflate in the last several debt deflation periods where the free market tried to assert itself and acknowledge how much malinvestment there was. The reason why the central banks were able to get away with that is because there were unencumbered assets in the economy that had not yet been encumbered by a new dollar of debt, either explicitly or implicitly. And so the value of that dollar you had in your hands was literally a claim on all the unencumbered assets in the US economy. That's, well, I wouldn't say literally. It was implicitly a claim on all the unencumbered assets in the US economy. We don't know how much of that is left. It's probably not that much. And we just basically added another 7 trillion of debt in the stimulus programs.
Is that all?
Well, we'll see. Like I said, when this all started, I think 10 trillion, Doug Nolan had predicted that the Fed's balance sheet would expand by more than 10 trillion in this next crisis. He's been predicting that for a long time. Well, here we are. And the Fed's balance sheet is now north of 6 trillion. It's not above 10 trillion yet, but I think most forecasts have it going to about 10 trillion by the end of this year.
Is this going to be us soon, right here? These Zimbabwean $10 trillion notes?
Yeah, I carry one of those in my wallet as a reminder of history. I also carry an old Russian ruble that a friend gave to me in 1989. So one of the really old ones, pre-Soviet collapse. Those help you understand economic history for sure.
Yeah, because
you made a comment about the epic short squeeze of the dollar.
Yeah.
And when this happens, and as the whole ball sort of rolls, and it's gonna be crazy. What happens when the short squeeze happens, and what does the short squeeze mean?
Well, we're experiencing it right now, right? The dollar, in spite of the fact that we've just added $7 trillion of debt explicitly onto the aggregate balance sheet of the United States, and the dollar's still rallying. Normally, you would think that the dollar would actually be correcting. Why is it rallying? Because we're such a gigantic short position in the U.S. dollar offshore. It's mostly offshore. It's non-U.S. borrowers who needed dollars for global trade. And that is the exorbitant privilege that the French finance minister was referring to with making the U.S. dollar the world's reserve currency back in the 1960s. Well, it was a reserve currency before then, but basically after Bretton Woods failed and the U.S. basically started borrowing to consume more than we produced explicitly in 1968, and that's when the French finance minister was especially complaining, and he was right. The U.S. was basically living off the rest of the world because we were consuming more than we were producing, and because we had the world's reserve currency, we could afford to finance it. But eventually, the so-called Triffin dilemma, the reserve currency curse, tells you that we will eventually overissue the U.S. dollar. And eventually there'll be more supply than there is demand. Right now, what that short squeeze is telling you is that there's more demand for dollars than there is supply. But that's not a permanent thing.
But the printer's going brr, so eventually the supply will outmatch the demand. I have a question. So you've been doing some amazing, epic things there in Wyoming, and getting Wyoming to be the most blockchainiest state in all the lands. And so what are some new updates?
Excellent
there?
wordification, Mr. Travis Wright. Blockchainiest. Awesome. Yes. Good job.
Yeah. Well, we've now enacted 18 laws in the last 3 legislative sessions. And I actually have a piece of news. I don't think I've publicly announced this yet. Governor Gordon just appointed me to the new select committee on blockchain and innovation and technology in the legislature. So I'm obviously a civilian. I'm not an elected official. There are 3 civilians who will serve on that. So we retired the task force, and now a permanent committee has been formed. So yeah, so I actually tried, because as you know, I'm busy with a startup. I tried not to serve on it, but got my arm twisted by the folks in the state.
Hey, it's for the greater good. You know what? And you're moving it all forward, and you're one of those, those prolific rays of sunshine out there in the blockchainy universe that's spreading the blockchainy goodness. So thank you.
Well, thank you. It really is an honor to be asked to serve and to do that again. I will find the time and make the time. We're going to be looking at digital identity and strengthening the laws around digital property rights. One of the bills I didn't talk much about in my Twitter feed last legislative session. One of the bills that got passed essentially is a safe harbor for digital speech, for free speech. It's essentially that developers cannot be criminally prosecuted for merely writing code.
That sounds good to me. I mean, it's crazy the way the statutes can be abused, right?
Maybe Ross Ulbricht might like that law.
Yeah.
Yeah. Well, it was the real example that a lot of folks pointed to is Cody Wilson. So really, if there's a crime committed, it's the use of the code in an illegal way. It's not the writing of the code in itself. And so I think you'll see Wyoming do some of those kinds of things. There are a lot of people who really care about supporting the technology industry here from a philosophical point of view. And so, yeah, this is, it'll bring the ideas my way too, by the way. I'm just a conduit from the industry bringing all these good ideas forward to the legislators who are looking for things to do to support this industry.
If people have ideas and want to reach you, what's the best way for them to do that?
Tweet them to myself and Representative Tyler Lindholm. He's the tall guy in the big cowboy hat that you've seen in a lot of the photos. And then Senator Chris Rothfuss as well. That's unbelievable bipartisan cooperation between the two of them. And it just shows, when they put their minds to work, what they can pull off.
Fantastic. Well, Caitlin, thank you so much for participating. And you guys go look her up. Of course, there's links on the page at virtualblockchainweek.com. And we're watching you. We're going to see what you're up to next, because we know the best is yet to come.
Yeah, I'm watching you guys too. This is an awesome event. I'm so glad that you put this together. It's been fun to take a break. All of us are, locked in our homes, and so it's fun to take a break to do this and see everybody. I really appreciate you organizing it.
Absolutely.
Thanks for being part of it.
Have a good night. Thank you.
Have a good night. Indeed. Bye.